I must look like Nostradamus because a lot of you guys, you keep asking me to predict the future. Aaron, when are mortgage rates gonna drop? Aaron, when will rates be back down to the all-time low? When are we gonna see 2% again? As much as I would love to be able to predict the future, only the Simpsons are successful at doing that, guys.
What do you mean the bank is out of money?
Insolvent? You only have enough cash for the next 3 customers! Hey,
That being said, let's discuss what we do know, and that's the basics of what makes mortgage rates go up and down. I'm gonna give you my personal prediction of what I think is gonna happen with mortgage interest rates, which again, I mean, this is just a best guess. I'm an armchair economist. So let's dive in this video on exactly what's making rates go up and down. So when it comes to mortgage interest rates, home loan rates, when we're talking about a mortgage is actually a bond, a mortgage-backed security. And the value of bonds is directly impacted by inflation. Why? Because a bond is basically an agreement to make payments into the future. And that payment is fixed, it doesn't change. And if inflation increases, then the value of that payment that I'm making a year from now, 3 years from now, whatever, it's not as valuable because I'm still paying the same as I was today, but the price has gone up, inflation's gone up, which that erodes the value of long-term debt. So a mortgage, a home loan, that's long-term debt. So it's directly impacted by inflation. So if you wanna just boil it down to the very basics, when inflation goes up, interest rates go up. When inflation comes down, mortgage interest rates will come down. Hey, are you thinking about buying a house, but you need help with your down payment? Well, you're not alone, and I've got you covered. I've created the ultimate down payment assistance guide, which is available for you to download for free below. I'm telling you, this guide will save you hours and hours of research. Hope you like it. All right, so let's talk about what do we actually need in order for mortgage rates to come down from where they are right now? Like, what specifically am I looking for when I'm scanning the economy and trying to figure out what's gonna happen? First off, the Federal Reserve, they gotta stop tightening. They keep raising the Fed funds rate, which does not directly raise mortgage rates. That happens through trickle-down economics. But when they raise the Fed funds rate, that squeezes the consumer even further. It makes their credit cards, car loans, lines of credit, all those things become more expensive. That also squeezes businesses more. It makes it harder for banks to lend. So ultimately, that all trickles down and ends up causing mortgage interest rates to go up typically. Now, that doesn't always mean that when the Fed raises their rate, that mortgage rates go up. Sometimes when we see the Fed raise their rate or tighten, we'll actually see rates come down. But we're not in an environment like that right now. We've already kind of made our way through that. Now what the markets are really looking for is the Fed to stop tightening. So that being said, I want to know, what do you think is going to happen? Like, what do you think needs to take place in order for the Fed to stop tightening? Let me know in the comments below. I'd love to hear your thoughts on this. In my opinion, it comes down to basically 2 things. The first thing is going to come down to the labor markets. What I'm talking about is employment. The more people that are employed, the worse off it's gonna be for home loan rates. I'm sorry guys, but to be the bearer of bad news, but if you wanna see lower mortgage rates, then you better start rooting for a bad economy, because the closer that we get to a recession, the quicker we're gonna see the Fed stop the tightening and potentially start doing easing. Remember that whole quantitative easing phrase that they like to use? Basically spending a bunch of money versus taking money out of the economy. And unfortunately, the labor market has been really resilient. However, the numbers keep getting updated. It's funny how government reports work. The initial report that we get, it's always rosy. And then every month and, all the way out to a year, as they make these revisions, as they get more data in, the numbers usually adjust their way down, but the damage is already done at that point. The market has already shifted, the rates went up or down because of that info. So when you see the Bureau of Labor Statistics jobs reports, when you see the ADP job report, when you see the JOLTS report, be on the lookout for negative labor data. That's gonna be a sign that the Fed is gonna stop tightening, which should be good for mortgage rates. So the other thing that we need in order for the Fed to stop tightening is we need inflation to be coming down. And in fact, the Fed has set a target of 2% for inflation. It's not like they're not gonna have any inflation. They want less inflation. Well, in order for that to happen, there's 2 things that they're really monitoring. There's the personal consumption expenditures report, and then the CPI, the Consumer Price Index. And basically, these are just two different reports that look at all different segments of the economy and look at how much goods cost you as a consumer. Like I said earlier, inflation is the enemy of interest rates. So in order to see home loan rates go down, we need to see inflation go down. So every single month, we get a new report for the year-over-year reading for the PCE and the CPI. So keep an eye out on that, because as inflation comes down, the Fed is gonna pull back, they're gonna stop tightening, and at a certain point, if the labor market gets choppy enough, they'll start easing. And when you see that, it's gonna be time to bust out the champagne and caviar and refinance your mortgage, because rates are gonna plummet. That might be your time to buy a house if you're one of those people that's sitting on the sidelines because of where rates are at. Although I've got other videos that mathematically is not a winning strategy. Now, there's a piece of information that recently was in the headlines that credit card balances for US consumers had reached an all-time high. Collectively, US consumers owe over $1 trillion in credit card debt. Now, delinquencies on credit cards are rising. Rates on credit cards have been rising because when the Fed raises the Fed funds rate, credit card rates go up. That makes it harder to make those payments. So the squeeze is getting further put onto the consumer. So although that really sucks, and I don't wish anything negative on anybody, that's good for the narrative of going into a recession. Keep an eye out on that, because this has been in the spotlight and those numbers keep going up and up and up. Credit card balances are going up. Personal savings rates are going down. In fact, they're at a record low.
'Cause I have $30,000 in credit card debt. When they call, I tell them I can't pay it back yet. Credit card debt.
So one of the questions that I get is, when are rates gonna go back to 2%? At the end of the day, I think it's when pigs are gonna fly. Why is that? The only reason rates came down to 2% for a period of time was because the Fed, the government, they did some unprecedented monetary policy. They bought tens of billions, trillions of dollars of mortgage-backed securities. They were creating a demand when the demand didn't exist, and they were buying more than anybody else wanted to buy, driving the price down, further stimulating the economy, which was needed at the time. But you know, things got a little crazy. So are rates gonna come back to 2%? Probably not. I mean, unless we have some crazy macroeconomic event that requires the government to step in and take drastic measures to right the ship. Otherwise, I think that we'll be lucky to get back into the 5% zone, which was a few years ago considered a really low rate historically. I mean, you gotta put things into perspective. Over the life of interest rates, of mortgage interest rates, going back into like the 40s, the lowest rates usually were at was like 5, 6, 7%. Average was around 6-something% over the last 80 or so years. So to think that all of a sudden 2% is gonna come back, that's totally unrealistic, and I would not be planning for that. I think that mortgage rates are gonna come down sometime in the second or third quarter of 2024, basically next year. I know a lot of people were expecting interest rates to be down this summer. I was one of those people. Again, I'm not perfect. I can't predict the future, but based off of historic info, historic trends, the technical data that was available at the time, it seemed very logical that we were gonna see interest rates start to come down in June and July as inflation was coming down. But what happened? We had all sorts of curveballs thrown at us, like the debt ceiling debate, like the banking crisis, like all sorts of geopolitical issues all over the world, Ukraine. There's all sorts of things taking place that tug and pull on mortgage-backed securities through the bond market. All of this stuff is all tied together. And so when things happen, a lot of times it can impact mortgage interest rates, even though it doesn't have a direct effect on it. So based off of the landscape that we find ourselves in now and where I think we're gonna be, you're gonna see mortgage interest rates in this zone that we're living in for probably the next like 6 to 12 months. So that brings me to my next point. If you're watching this and you're somebody that you've been thinking about buying a house, but you're sitting on the sidelines because you wanna wait for mortgage rates to drop. Like, trust me, I have this conversation all the time. I get the logic behind it, like why that would seem to make sense. But the thing that you're not factoring in is that home prices are still going up. So how much more are you gonna have to pay for something in the future? I did a whole breakdown of that, a deep dive video where I talk about the math, and it'll blow your mind. You should check it out. Bottom line, it costs you tens of thousands of dollars to wait. Even if you take higher rates now, you can always refi later. But if you wait to buy, you're gonna pay more in the long run. Now, if you're watching this and you already own your home, you got a mortgage, and you're one of those people, you're waiting for rates to drop so that you can refinance and lower your rate. Maybe you wanna do a cash out refinance and consolidate debt, whatever. By the way, if that's the case, it might be a good decision to do that now. And then maybe you refi again when rates drop again. It all depends on how much money that you can save. But the point is that if you want to refi, you have to be ready to pounce because one, we don't know when rates are going to drop. We don't know exactly when that's going to happen. And if you're waiting for like the news to tell you when rates drop, they're always weeks and weeks behind on everything. They're never up to speed on mortgage and real estate. And so we don't know how long rates are going to come down. And when they come down, how low are they going to go and how long are they going to stay at that level? So go to bereadytorefi.com. Give us a little bit of information about yourself. We're not gonna bug you and call you all day long, but when rates do drop, we're gonna reach out to you and let you know that now's the time to pounce. We'll provide you with the information you need to make an educated decision at that time, and hopefully you can save a whole bunch of money. I hope you got value out of this video. If you did, do me a huge favor. Tap that like button. I'd love to hear your comments as well. When do you think rates are gonna drop? Do you think I'm stupid? Do you think I'm wrong, right? I'd love to hear your opinions on this stuff. And if you'd like to work with my team on a home loan, we'd love to help you. You can get a hold of us. Our contact is in the notes below, and I'll see you on the next video.